2024 has not been a great year to be a Fundrise investor. As you can see, my account is slowly creeping up. And meanwhile, the S&P 500 is up 19.5%. So had I stuck my original starting amount of 130,000 into the S&P at 19.5%, I'd have 155,000 right now instead of my 137K sitting here in the Fundrise account. And so the question is, did I just lose out on 20 grand or 18 grand? Well, yes and no. I lost out on it by not having it invested over here. But of course, that's easy to say in hindsight. It's kind of like saying, well, yeah, I lost out by not buying Apple in 2004, or by not having invested the cash that's sitting in a savings account. It's not like it is serving no purpose at all. It's there for an emergency. It's a hedge against volatility, even if it quote unquote costs you money in the form of unrealized gains. Now, reason for this video, there's been a few requests for an update to the video I did on Fundrise last year. So this is me doing that. As I mentioned in the earlier video, Fundrise isn't paying me to make this, but I am a long-term investor on the platform. I'm a member of their affiliate program as well, which means if you sign up through my referral link in the description, I will earn a commission for that. All opinions are my own. If it's a fit for you, thank you for signing up through that link and supporting the channel. Now, where it gets a little confusing is there are a few factors contributing to this 6,300 net return figure. First, I've continued my automated $500 monthly contributions. So that's 10 months times $500 for 5,000 in total. And the Fundrise has also paid me out, I would call it $4,000 in dividends. So it's getting close to a net zero, essentially just reinvesting the dividends to grow the account. But since it can take some time to withdraw your funds, I like the flexibility and consistent quarterly cash flow of having those deposited straight into my bank account. And that cash flow was one of the things that attracted me to Fundrise in the first place way back in 2015. And I want to show you what I mean is, as you can kind of see during the accumulation phase of the account, the bottom line is the amount that I'm contributing to the account. And then you see like kind of the gain is that spread or that top line. But during this accumulation phase, it's going up fairly steeply, and then it starts to level off as the dividends start to almost equal out what I'm putting in. So again, you can see the quarterly and annual percentage returns down here at 3.6 for the real estate and 6.1 for the private credit, given a weighted average of just 4.8% for the year. Which you might be thinking like I am, well, shoot, I could have made 5% sitting in cash this year without any of the liquidity risks of Fundrise, and you would be 100% fair in thinking that. But what is unfair is to judge a long-term investment by just a 9-month window. I knew getting into this that this cash is going to be committed to a long-term buy and hold strategy, 5+ years, because I liked the mentality and the approach of Fundrise as a company. The idea of a tech-enabled, pre-vetted, diversified portfolio of commercial properties, that appealed to me. I bought into it. And they're very clear about the asset classes that we like. Hey, we like Sunbelt residential properties. We like last mile logistics support facilities. And if you believe their marketing material and honestly their track record at this point, the company's been around long enough, it's a portfolio designed to perform well over the long haul, trying to take advantage of macroeconomic trends with less volatility than publicly traded REITs and the broader stock market. That means you're unlikely to see sky-high 20% returns, but it also means that theoretically you should have some protection in bear markets when everybody else is suffering, which is why I'm not particularly stressed that this segment of my portfolio lagged the S&P this year. In fact, maybe 2022 is a good example. So here's like the annual returns by year. 2022, the S&P took a 19% nosedive, yet the Fundrise portfolio was up 4%. Should it be your only Investment? Absolutely not. Could it be a piece of the pie? Sure, if it aligns with your investing goals. And if not, there's plenty of other places to go and park your cash. Now, over the life of the account, this is annualized, I'm at 7.2%, which is good. It's okay, but it's not great. I could have grown my investment much faster in that straight S&P 500 index fund because, look at this over the last 10 years. But I would have had to stomach a lot more volatility along the way. And there's a reason the biggest endowments and fund managers in the world don't keep 100% of their portfolio in any one asset class. If you're looking for the investment that's going to give you the highest percentage return, I definitely would not recommend Fundrise to be that vehicle. It's just not what it's designed to do. And maybe a more apples to apples comparison would be to pit it against an actual real estate fund like V&Q instead of the S&P, which does make the Fundrise performance look a lot better, again, without as much volatility during that time. Now, I'm assuming this is over a 5-year window. V&Q is at 2%. I'm assuming that doesn't include the dividends paid out over that time. And I've got V&Q in my portfolio as well, just to build up that real estate piece of the pie chart. Now, I did have some questions and comments on the last video about withdrawing your funds. So last year I sold off a small portion of the portfolio, about $2,000 worth. Okay, here it is. These redemptions. So it sold from the East Coast REIT and the Heartland E-REIT, totaling about $2,000. The good news is they did approve the withdrawal, which was good because the fine print says that Fundrise has the right to refuse or pause redemption requests at any time. Now, it did take over a month. I think you can see these paid out in October. I probably requested that middle of August, so maybe it was a 6-week window. And that was explained upfront. That wasn't any surprise. And it makes sense. Real estate is inherently illiquid. So in a lot of ways, it was probably faster than me going out and trying to put a for sale sign on an apartment building or something like that. But you want to know the investment that's paid off the most over the last 10 years. It's not Fundrise, it's not the S&P. It's super simple. It's been investing in myself and growing a business so that you have more control over your income. When you can build a business that you care about and you can give yourself a raise every year, you are going to really accelerate your wealth creation. Now, thankfully, the Side Hustle Show has hundreds of examples of how to do just that. Make sure to check it out here on YouTube or in your favorite podcast app. Thanks so much for watching. Cheers.